When we are using costing to make a decision, we need to think about the concept of shareholder value. So the fundamental assumption here is that in a private company, so this is a company that has shares. The shareholders are the owners of the business. And therefore, why does the business exist? The business exists to increase the wealth of the shareholders. Now, there are lots of debates about how that could be done and the different alternatives and things like that. But ultimately, a shareholder invests in a business in order to increase their wealth. Therefore, when it comes to making a decision, if we're dealing with a company, the question is, will this decision maximize shareholder wealth? Now, it's worth pointing out that this is normally, but not always, achieved by maximizing profit. But what we've just been doing with relevant costs is all about maximizing shareholder value. So in this case, shareholder value is the return to shareholders, and the return can take two forms. It can take the form of dividends paid and an increase in the share price, either of which will increase their wealth. Now, how do we calculate it? We calculate it as the present value of future free cash flows. So those are my relevant cash flows. That's why this relevant costing is so important, because if I'm looking at relevant cash flows, that will determine whether or not I'm going to increase shareholder wealth. And what we do is we discount those cash flows at the weighted average cost of capital. Now, that will make more sense later in your studies, but it's referring there to the time value of money. The fact that £100 in a year's time is not as attractive as £100 today. So when we discount cash flows, we're reflecting that figure. Okay, you'll see much more of that later there.